Morning Philippines. Today we are going to discuss all topic about merchandising operations. Our first topic will be discussed by Ria Liza Espina reporting from Lutayan Sultan Kudarat.
Thank you, Reggie. Today we are going to discuss the difference of income statement between service and merchandising business. Service entities perform service for a fee. In ascertaining profit, a basic income statement is all needed. Profit is measured as the difference between revenues from service and expenses. In contrast, merchandising entities earn profit by buying and selling goods. These entities use the same basic accounting methods as service entities, but the process of buying and selling merchandise requires some additional accounts. This process results in more complex income statements. To provide a better measure of performance, the income statement of a merchandising business is presented with additional items. Service business provide services and expertise to earn revenue. Business such as restaurants, salons, and hotels. On the other hand, merchandising buy and sell food to earn profit. Business such as malls and dries retails. We will see the formula used to compute for the profit in both service and merchandising business. Back to you, Reggie.
Thank you, Ria Liza. And now let's hear another report that will be given to us by Patricia Cabang, City of Coronadal.
Thank you, Reggie. So today we are going to discuss about the operating cycle of a merchandising business. When we say merchandising entity, purchases inventory, sells the inventory, and uses the cash to purchase more inventory, and the cycle continues. For cash sales, the cycle is from cash to inventory and back to cash. When we say sales on account, the cycle is from cash to inventory to accounts receivable and back to cash. Always remember, the faster the sale of inventory and the collection of cash, the higher the profits. Merchandising businesses use various business forms and documents. This is the importance to help and to identify the transactions that should be recorded in the books. These source documents contain vital information about the nature and amount of the transactions. So we have 10 source of documents. First is the sales invoice. When we say sales invoice, it is prepared by the seller goods and sent to the buyer. It includes the name and address of the buyer, the date of sale and information, the quantity, description, and the price. It is about the goods sold. It also specifies the amount of sales in the transportation and payment of terms. Number 2, the bill of lading. It is a document issued by the carrier tracking, shipping, or airline that specifies contractual condition and terms delivery such as freight terms, time, place, and the person named the received goods. Number 3, the statement of account. It is a formal notice to the debtor detailing the accounts already due. Number 4, the official receipt. It is evidences the receipt of cash by the seller or authorized representative. It notes the invoices paid and other details of payment. Number 5, the deposit slips. When we say the deposit slips, it is printed form which depositor's name, the account number, and space for details of the deposit. A validated deposit slip indicates that the cash and checks with the supplied details were actually deposited or credited to the actual holder. Number 6, a check. When we say a check, it is a written order to a bank by a depositor to pay the amount specified in the check from his checking account to the person named in the check. When we say payor, it is the entity issuing the check. The payee is the receiver. Number 7, purchase requisition. Purchase requisition, it is a written request to the purchaser of an entity from the employee or user department of the same entity that goods to be purchased. Number 8, the purchase order. It is an authorization made by the buyer to the seller to deliver the merchandise as detailed in the form. Number 9. The receiving report. It is a document containing information about goods received from a vendor. It formally records the quantities and description of the goods delivered. Last, the number 10, the credit memorandum. It is a form used by the seller to notify the buyer that his account is being decreased due to errors or other requiring adjustments. Back to you, Reggie.
Thank you, Patricia. And now let's hear another report that will be given to us by Mary Liza from Tantangan, South Cotabato.
Yes, Reggie. Step in a purchase transactions, purchase or sale of merchandise. Of course, the buyer and the seller should agree on the price of the merchandise, the payment terms, and the party to shoulder the transportation costs. First is when certain items are needed, the user department fills in a purchase requisition forms and send it to the purchasing department. The second is the purchasing department then prepare a purchase order, the checking and the price list quotation or catalogs of approved vendors. The purchase order addressed to the selected vendor indicates the quantity, description, and price of the merchandise ordered. Then, third is, after receiving the purchase order, the seller forwards an invoice to the purchaser upon shipments of the merchandise. The invoice and the sale invoice by the seller of a purchase invoice of the buyer. Then, the fourth is, upon receiving the shipment of merchandise and the purchaser receiving department sees to that terms in the purchase ordered are complied with the prepares receiving report. And the last is, before approving the invoice for payment, the accounts payable department compares copies of the purchase requisition, purchase orders, receiving reports, and invoice to ensure the quantities, descriptions, and the price agreed. Purchase requisition, purchase order, invoice, and receiving report are source of document.
Thank you, Mary Liza. And now let's hear another report that will be given to us by Christine Hako from City of Coronadal.
Thank you, Reggie. So good morning, everyone. Today we're going to discuss cash discount and trade discount. So some businesses give discount for prompt payment called cash discount. If trade discount is also offered, cash discount is computed on the net amount after the trade discount. This practice improves the seller's cash position by reducing the amount of money in account receivable. Cash discount is designated in such annotation as 2/10, which means if there is 2/10, there would be 2% less on the principal amount. So the period covered by discount in this case is 10 days. This is called discount period. Sometimes it also shown in terms of n/30, which means n is the days wherein the debtor can pay the payment and over 30, which is the due date of the payment. Cash discount are called in two ways: purchase discount and sales discount. Purchase discount if you are the buyer, and sales discount if you are the seller. It is usually worthwhile for the buyer to take discount if offered, although it may be necessary to borrow money to make the payment. So the other discount is called trade discount. Trade discount is a routine reduction from a regular established price of a product. The use of trade discounts allows the company to vary the final price based on each customer's volume or status. Trade discount encourage the buyers to purchase product because of the markdown from the list price. This type of discount enables suppliers to vary prices periodically without the inconvenience of revising price lists and categories. There is no trade discount account and there is no special accounting entry for this discount. Instead, all accounting entries are based on the invoice price, which is obtained by subtracting the trade discount discount from the list price. Invoice price is the initial price that the manufacturer charges the dealer. The difference between cash discount and trade discount, the cash discount is usually used when you are borrowing money from a bank or you are investing some money. While as trade discount can be seen in the malls or when we are shopping.
Thank you, Christine. And now let's proceed to another report that will be given to us by John Lloyd Babatuan from Surala, South Cotabato.
Thank you, Reggie. So now I will discuss what is transportation cost. Transportation cost, also called as freight cost. Freight cost is the expenses a company incurs when it transfer its inventory or other assets to another location. The freight bill designates which party shoulders the cost and whether the shipment is freight prepaid or freight collect. So, freight prepaid indicates that the shipper or consignor is responsible for the shipping charges, as well as any ancillary charges that might come up along the way. FOB origin, freight prepaid. In this scenario, the buyer takes ownership of the shipment when it is picked up by the carrier. Freight collect means that person or company that receives goods will pay the cost of transporting the goods at the time they are received. The agent of the shipping company will collect the freight in the port of destination before the goods are made available to the holder of the original bill of lading. Freight bills usually show whether the shipping terms are FOB shipping point or free on board destination. When the freight terms are FOB shipping, the buyer shoulder the shipping cost. Ownership over the goods passes from seller to the buyer. When the inventory leaves the seller's places of business, the shipping point, the buyer already owns the goods while still in transit and therefore shoulders the transportation cost. If the terms are FOB destination, the seller bears the shipping cost. Title passes until the goods are received by the buyer at the point of destination. While in transit, the seller is still owner of the goods, so the seller shoulder the transportation cost. In freight prepaid, the seller pays the transportation cost before shipping the goods sold, while the freight collect, the freight entity collects from the buyer. Payment by either party will not dictate who should ultimately shoulder the cost.
Thank you, Lloyd. And now let's proceed to another report that will be given to us by Lemmy Balsamo from Norala, South Cotabato.
Hey everyone, I am Lemmy F. Balsamo. Now, let's talk about merchandising inventory system. Merchandise inventory is the most common form of inventory that everyone knows. In simple words, it is the inventory that a company has in hand for sale at a given time. Merchandising inventory is a current asset with a normal balance of debit, which means the debit will increase and the credit will decrease. Merchandising entities has two systems available on how to record events related to merchandise inventory, which are the perpetual inventory system and the periodic inventory system. Perpetual inventory, or also known as continuous inventory, is a system where information on inventory is updated. It's allow you to regularly update your inventory records to help prevent situations like running out of stocks. while the periodic inventory relies on physical inventory. Periodic is where you update your accounts at the end of your accounting period. Your accounting period might be once a month, quarter, or a year. This two system is important to businesses because it helps them prevent stockouts, keeping tracks of account, and ensure the accurate records. This might also help you to understand your assets and maximize their potentials, thus improving your business's operations and increasing your profits.
Thank you, Lemmy. And now let's proceed to another report that will be given to us by Kirby Arandilla from Surala, South Cotabato.
And now we will discuss sales discount. These are discounts granted to customers for early payment of customers. Sales discounts are given by the sellers to the buyers. Example, assume that the Toya traders sold merchandise on September 20 for 3,000 pesos, terms 2/10 and over 16.
At the time of set, the entry is September 20, debit accounts receivable amounting to 3,000, credit sales amounting to 3,000 to record sales on credit.
Sales return and allowances. Buyers may be dissatisfied with the merchandise received either because of the goods have damage or defective, of inferior quality, or in accordance with their specifications. In such cases, the buyer may return the goods to the seller for the credit of the sale was made on account, or for cash refund of the sale was for cash. Alternatively, the seller may just grant an allowance or deduction from the selling price. A high sales return and allowances figure is not commendable because it may signal poor quality of goods and thus may result to dissatisfied customers. Each return or allowances is regarded as a debit on account and sales return called sales return and allowances. And examples of such transactions as follows. Sales return, debit sales return and allowances amounting 760 pesos. Credit accounts receivable amounting to 760 pesos. The seller usually issues the customer a credit memorandum. That is, accounts receivable or cash is credited, which is a formal acknowledgement that the seller has reduced the amount owed by the customers. Sales return and allowances is a contra income account and is accordingly deducted from gross sales in the income statement.
Thank you, Kirby. And now let's proceed to another report that will be given to us by Irish Truero from Santo Niño, South Cotabato.
I will discuss merchandise inventory. The inventory of a merchandising entity consists of goods purchased for sale for a grocery store. Inventory will be made up of milks, vegetables, canned goods, and other items. For lumber and hardware, it will be plywood, nails, paints, iron sheet, cement, tools, and other items. Merchandising entities purchase their inventories from manufacturer, wholesalers, and other supplies. The merchandise inventory at the beginning of the accounting period is called the beginning inventory. Conversely, the merchandise inventory at the end of accounting period is called the ending inventory. The ending inventory shown the income statement will be the merchandise inventory. To be reported in the balance sheet, effectively, the ending inventory of the current period will be the beginning inventory of the next period. Net cost purchases. Under the periodic inventory method, net cost of purchases consists of gross purchases minus purchases discount and purchases returns, and allowances equals net purchases plus transportation cost. Purchases. When the periodic inventory method is used, the purchases of merchandise are debited to the purchases account as shown below. Merchandise purchase is invoice price is known as the gross price method of recording purchase. Purchases, returns, and allowance.
Sale returns and allowance is the seller's books and recorded as a purchase returns and allowances in the book of the buyer.
Now let us learn purchases discount. Merchandise purchase are usually made on credit and commonly involve purchase discount for early payment. In relation to November 12 and 14 transactions, the payment is recorded as follows. So, on November 22, we debited accounts payable amounting to 13,000 and purchase discount, that is 13,000 multiplied by 2% is 260 pesos, and the cash that we paid is 12,740 pesos. That is the deduction of 13,260 pesos. Purchases discount is a contra account that is deducted from purchase on an income statement. If the entity makes a partial payment on an invoice, most creditors will allow the entity to take the discount applicable to the partial payment. The discount does not apply to transaction or other charges that might appear on the invoice. Purchase discounts are the reduction that retailers and stores get from their wholesalers. Purchase discount offered to stores can depend on the variety of factors such as the size of order, a cut in prices of raw materials, and etc. The suppliers' discounts are usually offered because the retailers buy product in bulk.
Transportation out. When the freight term is FOB destination, the seller shoulders the transportation cost. When the term is FOB shipping point, the buyer bears the shipping cost. Transportation out, also known as freight out or delivery expense. This is an operating expense, further classified as a selling expense. It is sold when merchandise is sold with terms of FOB destination. FOB destination, when the goods are received by the buyers at the point of destination. Let's see the case number 1. Assume that Gloria de Toya Traders sold merchandise totaling 17,000 pesos FOB destination. Freight prepaid term 2/10 and over 30. The transportation cost amounted to 1,900 pesos. The entry to record this transaction will be November 25 is the date. The account to entry is, or account record is account receivable. Account receivable is 17,000 and transportation out is 1,900 na nakaline siya sa debit. And sales, yung account receivable of Gloria de Toya is 17,000 and that is the sales, 17,000. The transportation out is 1,900 and that is the cost na freight collect ni freight collect is that is cost 1,900. Sales on account terms 2/10 and over 30 is FOB destination freight collect 1,900. For freight prepaid, invoice is collected on December 5. The sales discount will be 340 pesos. Transportation out is an operating expense. On December 5, cost is 16,660. Ang sales discount niya is 340. 340 kasi 17,000 times 2 that is 340. Ang accounts receivable is 17,000. Cost of sales, or cost of goods sold, is the largest single expense of the merchandise business. It is the cost of inventory that the entity has sold to customers. Cost of sales is the cost of the merchandise that was sold to customers. The goods available for sales during the year is the sum of two factors. The two factors are merchandise inventory at the beginning of the year, net cost of purchase during the period. To find the actual cost of sale, the merchandise inventory at the end of the period is subtracted from the goods available for sale. Gloria de Toya started with 528,000 pesos in the beginning merchandise inventory, and net cost of purchases or cost of goods purchased of 1,268,600 during the year. At the end of the year, 483,000 of goods were left unsold. This amount should appear at the merchandise inventory. When this ending merchandise inventory is subtracted from goods available for sale, the result cost of sales is 1,313,600. On Gloria de Toya Traders' partial income statement for the year ended on December 31, 2019. Cost of sales. Merchandise inventory January 1, 2019 is 528,000. Purchases is 1,264,000. Less purchases return and allowance, purchases discount. The total purchase return and allowance is 58,400. Purchases discount 21,360. The total of purchases return and allowance, purchases discount is 77,760. The total of purchases is 1,264,000 less to purchase return allowance and purchases discount. The net purchases is 1,168,240. Transportation in the net purchase add to transportation in, and that is 1,268,600. The beginning of merchandise inventory add to net cost of purchase. The result is cost available for sale. 528,000 add 1,268,600. The result is 1,796,600. The goods available for sale less to merchandise inventory or goods were left unsold during at the end of the year. 483,000 the goods that were left unsold. The result is cost of sales, and that is 1,313,600.